Hey everybody, how's it going? My name is Brad, and it has been an absolute minute since I've made a video, or so it feels like. I took a short on EURUSD yesterday. A lot of people were asking for me to prepare a trade breakdown, so I figured let's get into it. So what I'll do is we'll start with the daily charts here on Eurodollar. What we can see from the daily chart is that we've started to see a change of character. We've broken the low, we've created a high and a new low. We wicked this low, taking the liquidity, but we didn't necessarily break and close below it. But what we can see is we did break above this swing high. If we're looking from an actual change of character perspective, we could even take it a step further and look at this low. We wicked the low and then we broke this high. So we did get an initial change of character followed by a break of structure. So this is starting to give us some confirmation that the daily, at least for the interim, is switching bullish. So it gives us an idea of how to plan our trades. But what we can see if we just kind of scrunch the chart up a little bit is that price has been predominantly bearish in nature. We've been seeing a lot of downwards price action for the last few months. And this, in theory, could be a temporary pullback or, temporary little bit of bullish structure, as we've seen in this bit of price action where, we created a high, we broke to the downside, and then we broke to the upside, and then just continue to break to the downside. So we need to pair this with some of the higher time frame momentum just to get a sense of what could be happening. Cleans up some of the noise that we see even on the daily charts. So it's just a good practice to have when you're a little unsure of where price is likely to go. But one thing I do want to point out is we shouldn't be trying to predict the markets in a way that price has to do this or price has to do that. What we should be doing is using our timeframes, especially higher timeframes, to really just give an understanding of what is going on so that we can react properly to the price action that's given. The majority of us, or at least a high significant amount of people inside the community, are more session-based traders or day traders, either focusing on the London or New York session. So your job as a trader in that regard is to react to what is happening in those sessions, to build trade ideas that, for one, complete in that session and maybe even continue into another session. And that's the primary foundation of that trade. But if we're just looking at the weekly chart, what we can see, if we look that we were pretty bullish, we've had this swing high, we had this swing low, price was moving to the upside. We reacted to a weekly supply level or supply range. We started to see price trying to push down, was unable to do so on the initial push. We reacted to some sort of demand and tapped back into this range, and now we've started to see price moving to the downside. The key bit to take note of is that we've actually broken these swing lows. We've only just broken them, but it's definitely an important thing to note when we're looking at the structure here on the weekly chart, because when we start to break key levels of structure, especially on daily, weekly charts, what we tend to see are pretty aggressive pullbacks. Now, what we can see if we just take a step back is I showed on the daily chart an area where price went bullish in a bear trend and then immediately went bearish again. So we did get a change of character with a break of actual swing structure, but the move wasn't sustained. This is where we can actually use this concept on the weekly chart to just kind of get an idea of what's actually happening, because what we knew when we were looking at the weekly chart, and I'll use a straight line just so I don't have to try and draw a straight line, is we were operating under this range. We had this swing low, we had this swing high. We knew that the market was bullish. We reacted off of the supply zone. So we know that supply is more than likely going to be taking control for the moment. Now, whether it breaks swing structure and starts to create an actual downtrend on the weekly, we're not sure. We're just reacting to what we see. Of course, we're looking at a weekly chart. So when we're looking at this, what we can see is we have intermediate swing lows, basically a minor level of structure right here. What happens when we break this structure? We pull back and create a much more sustained or larger pullback. And even more specifically, if we just look, we create some equal highs. And if we look on lower time frame structure, basically what this move is it's a sweep of liquidity, but on the weekly chart, it's not quite there. But that is why on the daily chart, we've seen a little bit of a bullish rally, because we took out some significant structure. We took liquidity here, and then this was the market's opportunity to try to push price into more of a premium level or just a higher price to provide more sell opportunities at a higher price if that's what the market was looking to do. And of course, when we translate that to the daily chart, we've seen a move to the upside, a change of character, but it didn't last and we continue to the downside. So we're kind of seeing that right now. If we kind of look at it, now we've broken a key level of structure. So it's only natural that we're going to get a pullback. Now, if we're looking at that and we're trying to say, okay, if I'm looking for a continuation trade to continue selling this short, where would I look? I would probably be looking at something like this. We have a inside bar here, and what we can see is this candle just barely takes liquidity. We'll just zoom in just to make sure that I'm not just saying that. Oh, maybe not. It's actually an equal high. So we have 87, and this one is 91. So we just barely take liquidity, and then we run to the downside. So we have that, and what we can do is we can use this inside bar as our level of supply, just to give us a reference. Now, we're not going to actually sell this zone when price comes into it. What we'll be doing is just using this as a basis of saying, you know what, supply's in control right now. This is a key area. If we break through this supply, then chances are we are going to continue bullish, especially on a weekly perspective, because we might see moves intraday, intra-week. But if we're following weekly momentum, that's where it becomes a little bit more prevalent, and we can get a better idea of sentiment, and then we can forecast what's going to happen, but more specifically, we can forecast so that when price starts doing things, we can react accordingly. So now that we have that understanding of why a pullback would more than likely come into play, we have a level of supply where if price does remain bullish on, say, the daily, the 4 hour, 15 minute, 1 minute, this would be a logical target, but a logical area also to potentially look to go short as well. And then on the flip side, if price does just continue bearish, what we would be looking at is something of price of revisiting more or less this area is what I'm looking at, but there is this range where I would likely see some sort of reaction. So if I was looking to trade short within this area, this would be the first real logical target, because if we're looking at internal range liquidity, what we can see is price created a low here. We've taken that low now. The next logical range of internal range liquidity on the weekly would be this area, and then we do have a demand zone here. Price can continue trading lower, of course, but we're going to trade with what's more local at this stage before we kind of just jump into everything else. So we'll jump back down to the daily now. What we can see is we were getting that pullback. This is the basis of the trade. So the idea of looking for a sell is based on the understanding that we have a demand zone here. Price just barely takes liquidity. Once again, seems to be the theme. We take liquidity and then we move to the upside. So we have two things, and this will maybe help some people. Some people are maybe a little bit confused on what a change of character is versus what a break of structure is. So in this case, we're looking prices in a bearish trend. We have our swing structure. We have a swing low. We have a swing high. We have a swing low. And if we look here, we don't actually break and close below this swing low. So this wouldn't be a valid low from a swing structure perspective. But what we can do is use this as a change of character point. And what I mean by that is if we just draw on a line just like this, we can see that we break with a wick, and on a lower time frame, this would actually be structure. And we'll see that on a 4 hour where we started to actually change character much earlier. And that's the indication of the lower time frames building up to the higher time frame. And then what we can do is we can use the most recent high to figure out where our actual change of character would take place. So what we can see is price breaks to the downside, creates this low, and then we break this high. This is our initial change of character. This is the indication that the trend might be starting to change. It's the early indication of that. Now, we can see is we still have this swing high. When we know that this swing high, if it's broken, then that means the bearish trend has been violated, so to speak, and that a bull trend could be in the works. The reason I say could is because one break of structure is not indicative of an actual trend change. What we want to see is a new higher high form, a new higher low form, and then a new higher high. Once we have that second higher high, we have a much stronger indication that a bull trend is actually taking place after the bear trend. So with that understanding, I was looking at this knowing that we have a good level of demand. We've taken liquidity. We've broken swing structure. We've seen a change of character. This is now, for the moment, a protected low because we've broken that structure and taken liquidity. So we have a lot of good things going for it. We can also see that we're starting to have lows that are trading just above this zone. We could use that as a level of inducement for future POIs within this level of demand. So from an expectation standpoint, if I'm looking to trade this short, my targets would likely be in this spot, at least initially looking at the daily chart. So we'll take that a step further. We'll go to the daily chart now. And what we can see, or the 4 hour chart, I should say, we're on the daily. So we're on the 4 hour chart. What we can see is with our change of character and daily structure, we can see that the change of character was kind of this range. On the 4 hour, it's pretty similar. What we can see is we have the same low because our swing high would be more or less probably right here. This is a little bit unclean price action, not a true pullback. I would view this as one impulsive leg just because this is more or less a pause in the markets. And so if I'm looking at that, what I can see is we take this previous low, which actually does break and close below. So the difference between the daily and the 4-hour here is we actually do get a true break of structure, very minimal, but it still counts because we do have a close below that level. So if we're looking at that, our swing structural high on the 4-hour would be this area, but our change of character high would be this area right here. So it's a little bit different because the change of character is definitely a little bit more aggressive in nature. We can use more recent structure versus a break of structure where we're using a little bit more wider structure. We're using the last high as our high or the last low as our low to kind of mark that out. So that's the main delineation between changes of character versus breaks of structure. I hope that's helpful in just kind of how I view it and how I use it, because what we can see is we wouldn't actually have a break of structure on the daily until we break this high. We wouldn't have a break of structure on the 4-hour until we break this high. But on the daily, or sorry, I should backtrack. We wouldn't have a change of character on the daily if we didn't break this high, but we wouldn't actually have a change of trend on the daily if we didn't break this high. Whereas on the 4-hour, we have a change of character and a break of structure that's aligned with the daily. So we have our change of character as well as a break of structure to the downside. Our change of character would be this high and our change of trend would be this high. So we're starting to see that alignment where the 4-hour change of trend is the daily change of character. And as price continues to move to the upside, we can start to see that. If we're looking at daily, if we're looking at 4-hour structure, I don't know why I keep saying daily at this point, we would have our swing low here. We'd have a new swing high here. Price pulls back, swing low, swing high. And now price is caught within this range in price. Now, what we can kind of gain from that is that price has created somewhat of a demand level in this area. It's not the cleanest. You know, we would probably go off of this bearish candle right here. We do wick below. This is where lower time frame refinements really actually come in handy because, let's face it, this is a mess. But on basic terms, you know, what makes this level valid? Well, we break structure to the downside, which we know as sell side liquidity. This is just a structural low. Price takes that liquidity, runs off, breaks what would be 4-hour swing structure. It also contributes to breaking daily swing structure as well. So it's a pretty powerful move. So we can use that as an area of interest and we'll refine on a lower time frame because that could be the catalyst that we need to then trade long if our weekly pullback is going to be significantly deeper. So now what we'll do is go down to the 15-minute. This will be my execution or trading time frame. I've already in bar replay at about, what time did I put this at? Put this at about 7 a.m. Eastern, which is pretty much when I start hitting the charts, depending on the morning. Some mornings it's a little bit later, depending on how my morning goes. But generally speaking, I try to be around that, whether it's on my phone initially, because I've done my analysis the night before, but I digress. So what I was looking at for the New York session is I noticed that we had a ton of liquidity being generated right here. This is more trend line, kind of structural liquidity. Basically, price is moving to the downside in a very corrective manner. And then what I've seen just above it is a pretty nice point of interest. We have a strong impulse. We have a correction. An impulse, the market moves in impulses and corrections. That's also what helps us form points of interest because those momentous moves are usually created by orders being placed in the markets and having that imbalance in the market. So what I was looking at here is we've broken structure. I was looking at initially this bullish candle before this large move to the downside. We'll slap on supply zone. So this was the supply zone. Yes, you could refine to this inside bar, include this wick. Yes, you can use just this wick. It really comes down to what you want to do. What I personally do when it comes to the 15-minute and the 4-hour, I like to be a little bit more broad with my zones because what I'm using them for is basically a point on the chart that I wait for price to get into. And the slightly bigger they are and less refined they are on the 4-hour and the 15 gives me a little bit more wiggle room on the 1 minute to be looking at the price action so I can either get in earlier or just have more confirmation within the trade itself. So what we can then do, now that we have our level, price is tapping into the level, it's tapping in about 7 a.m. We're gonna go down to the 1 minute chart, and this is where so to speak, the magic happens, I guess. This is my execution time frame. This is basically what I'd be looking for in terms of taking any sort of trade. So what I'm looking at when price actually gets into this zone is a change of character, because if we're just looking at it again, we'll go back to the 15-minute. I want to see a liquidation of some sort of liquidity. I want to see a higher time frame mitigation. Then I want to go down to my execution time frame. I want to see a change of character. I'd like to see a flip, and then that's when I smash the granny or take the trade. So if we're just looking at it from this perspective, what we can see is we have a massive liquidation of all of this trendline liquidity, this structural liquidity, however you want to view it. But basically, this liquidity void here has been filled. You know, we could draw the Dorito if we wanted to, just for Bants, but basically we would have, you know, something like that. You know, you probably can't even see that because for whatever reason it's really light, but we have a liquidity void, we have structural liquidity, however you want to, that's our liquidation of liquidity, just a lot of orders, whatnot. We have a higher time frame mitigation. In this case, the higher time frame mitigation is the 15-minute point of interest that I'm looking at. So now what we're doing is we're waiting for a change of character on the 1 minute. So what I would be doing is this would be my structural high that I'm looking at within this range. And basically what I'm doing is I just have 2 lines just to keep it super clean and just informative, because what I want to see for a proper change of character is one of 2 scenarios in this case, based on this price action. I want to see price move to the upside, breaking the high, which would then move our lower chalk line to here, and then a break to the downside. That would be the confirmation of the change of character. Or if I'm just looking at current price action, what I'd be waiting for is just a break to the downside. This is a change of character. Why? Because we are bullish and now we're switching to bearish. So if I just play price forward, and I'm not very good with bar replay, so we'll see how this goes, but I figured this might be a cool way to go through it. So what we can see is we broke into the upside. So we're just continuing this bullish trend. So what we can now do is we can look at kind of 2 points. Really, this is up to how aggressive you want to play your change of character. So we can use this swing low, because if we're looking at swing structure here on the 1 minute chart, what we can see is our lowest point before we broke structure was this point. So this is our swing structure. If we're looking for an actual change of character, we can use the most recent low, which would be this point here. So that's actually the point that I would be looking at, but I'm mindful of this low as well, because if we break this low and then continue to the upside, it doesn't give me that warm fuzzy feeling that price is truly changing character, but it might. So it's a little bit subjective, and I know that's probably not the most helpful explanation, but it comes down to just being aware of both levels, being aware of where your change of character would be and where your swing structure are. And if they're very close, like this, for instance, you know, it's about half a pip, I probably want to see that half a pip further downside momentum just to give me more confirmation that price wants to go to the downside. So we can see as we're still moving to the upside, so we can just move our line to the upside. This line to the upside isn't as important. It's just to be mindful that price can still continue to the upside. The more important line when we're looking at this bit of bullish price action is this bottom line, because once price breaks that low, this is where we have a change of character beginning, and this is when we can start to look for a trade. So now what we can see is price continues moving to the downside. We get a reaction to this level of demand, this doji right here. So this is just something that we would be potentially mindful of, is that we are reacting off of demand. We reacted right here. And now we wanted to see, you know, does this reaction get taken out? Yes, it does. So one thing that we can do immediately is just look at a supply zone here. And I don't know why that'll be easier. I keep going down here to change my templates, and I keep forgetting it's up here. So anyway, what we'll do is we'll just mark that as a supply zone. So now what we have here is a supply to demand flip. So basically we have a demand zone here. Price move to the upside. We've broken structure. We've taken liquidity. We can even go as far to say that this doji, that is the swing structure, is also the demand zone. But if we just look at it from a pure demand chain perspective, you know, we have a demand zone, we have a tap into that demand zone, which basically means that this is the newer demand zone. It's more relevant, it's more fresh. Nothing's been tapped into until we get to this point. We get that reaction. It's important to have an actual reaction when we're looking at supply and demand zone flips, because if we just went right through the level, that means this demand wasn't actually a demand zone, or it was so minimal that there was no transactional flow that caused price to maybe think about, you know, what's going to happen. Because, whether you believe it or not, there's an algorithm that is running the price feed that's happening, and it's offering bids and asks, pairing buy orders and sell orders. So when price hits a level of demand, if we see, a reaction such as this, that means that there was a lot of buying that was taking place, but the fact that it couldn't actually break structure to the upside means that chances are there's going to be a failure. We don't know that until it happens, of course. So it's just kind of understanding what's happening behind the charts. But we need to see that sort of transactional flow or that reaction before we see the failure, because then that gives us a stronger indication that demand has been taken out and a new supply zone has formed, and that would be our supply to demand zone flip. So let me just move this out of the way just a little bit. So we haven't actually gotten a chalk yet. We've just gotten supply to demand zone flip. So what we can also do is just be mindful of this level down here as well and just see what happens. But I'll keep it there because this is what I was looking at once the trade was taking place. So we can see as price breaks to the downside, we break swing structure. We're now bearish on the 1 minute. We have our change of character. We have a supply to demand zone flip. And now we're just waiting. Do we put a trade on here? We totally can. What I'll do is I'll just toss an order on. I like to enter around the 25% fib. So I'll just put a fib on here real quick. And I'll open that up just so you can look at the settings that I have for the levels, just in case you want to copy it or whatever. I just made it red to match a supply zone, but you can totally do whatever matches your theme. But basically, I enter on the 25% fib or the 0.25 level. I do have the 0.75 just in case I draw my fib upside down. It just works regardless. Basically, the theory of that is it's not quite equilibrium, but it's not quite the zero of the fib. So I'm getting a slightly better fill. I'm just not pushing it for equilibrium, so to speak, to be greedy, because I'm sure if you've taken any equilibrium trades, you miss a lot. Whereas with the 0.25 level, you tend to stay into trades a lot more. It's definitely something worth testing if you find that equilibrium kind of does you dirty a little bit. So anyway, so we can put the limit on here. Where would our stop realistically be? Do we need a 0.8 pip stop? No, that doesn't make sense. A 1 pip stop probably doesn't make sense either. The problem I see a lot with people, you'd be consistent if you just use slightly wider stops. Give price room to breathe. When we first started Phantom, really we suggested not going any lower than 3 pips. Now we have people who use 0.8 pips, 1 pip. Yes, your RR will be a lot higher, but you'll probably get tagged out of trades because of spread or just being too tight. So something like 1.5 to 2 pips is great. 3 pips, totally fine. But yeah, now what we can do is we can just keep moving forward and see what happens. What we can see is price is just kind of consolidating. If we're looking at from like a range perspective, our swing high would be here and our swing low would be here. This is just a bearish leg that we're trading in within on the 1 minute chart here. So what we can see is we're kind of creating relatively equal highs. So I can see some liquidity. So it's making this point of interest look pretty good. One thing that I'll point out is we do have this doji right here. And if we go back to the refine series, when we were talking about different refinements that we can use for supply and demand zones, we do know that dojis represent ranges on lower time frames. We know ranges to be important points of interest or areas of supply or demands that we can be aware of. So we can be mindful that this doji exists. What we can also view it as well is pivot wicks, because if we just look at this price action on a lower time frame, chances are this is what we're going to see anyway. That's what we know as a pivot supply range. So we could look for sells. Now, I'm not suggesting that we would put an order on this because the extreme just looks better, but what we can see is it's part of the reaction to demand, especially if we were to use kind of more of the range, which there's nothing wrong with using this entire range as your demand zone either. So it's kind of just a different way of playing it if you want. It's just being mindful of different bits that exist on the chart. So what I'll do is I'll just draw this on just as an idea. If we wick above it, then chances are this level is probably going to hold. Whereas, if we respect it, maybe something is changing within the overall analysis. So we'll just keep moving on. What I'll also do is just draw this. This is our liquidity that's we're looking to get taken. This, in theory, is the concept of inducement, where we have a pool of liquidity, whether it be equal highs, trendline liquidity, whatever you want to call it at this point. just before a point of interest or supply zone. So we can use that as an indication that price is more than likely going to gravitate to somewhere within this upper region of the chart. Why? Just because there's a lot of orders likely taking place here. So chances are this is just a better price. So we'll just keep moving on. What we can see is we move up, we take the liquidity. We've reacted off of this zone. So that's something interesting. We'll just have to see what happens next. One thing that we can also take a look at is that we do have a demand zone here. We break some substructure. Not the greatest demand, but it's just something to be mindful of. Now, I'm not suggesting that we're marking out this demand to trade it long or anything like that. We are trading the higher time frame. We're focusing on the 15-minute and the 4-hour. We're looking for sells because we're reacting off of a 15-minute POI. But what we can do with this demand zone is we can see that we've reacted off of the demand zone here. We've created this high. And in many cases, if supply is in control, which we can see now that we have a higher time frame zone, we have some supply zones we have some supply zones being created. We're looking for them to hold. We have a demand zone failing. We can even use this if we want as a larger demand zone as well, which then would be our interaction here. And then price creates the initial reaction. Chances are that that initial reaction to demand when supply is in control is going to get swept. This one's a little convoluted because we don't know supply is in control until we start seeing this bit of price action, more specifically this, when we see the change of character. But if we're looking at this, what we can see is we create a reaction that creates this high, price pulls back. What do? We take out that reaction. So it's doing what we want to see, pairing it with this level right here. Now, I said chances are we're probably not going to trade that level. If we were looking at that, and this is something I didn't clue in on at the time, this was about still 7:45, like almost 10 to 8 in the morning. I tend to be a little bit more active looking for trades at about 8 a.m., but I am kind of viewing charts from 7:30 onwards. So I did not look to enter on this, but that's okay because we don't need to. We can use this as an indication that a supply chain might be taking place. What is a supply chain? It's just a series of supply zones being created and respected. And usually when we see anywhere from 1 to 3 supplies being respected in succession, usually we'll see a release in price. What is a release in price? It would just be a larger impulse. Those are the moves that we want to be involved in as a trader. What we can see is price continues moving to the downside. We've now broken swing structure. So we've really confirmed that we're bearish on the 1 minute. So this gives me kind of that warm fuzzy feeling that this is probably a good area to be looking for trades. So with that said, what I decided I wanted to do is I kind of disregarded the extreme for 2 reasons. One, because this doji started to stand out to me. We've seen a respect of that level of supply with this move that broke structure. We've seen a lot of momentum come from it. We also had a sweep of liquidity. This was incredibly important to me. When I seen price sweep this liquidity, that gave me a better indication that supply chain might be starting at this particular area and that we don't need to revisit this top portion of the charts. And then finally, we do have a demand to supply flip. Our supply level then would be this area. We can use this entire candle if we'd like, which is what I'd prefer to do. In most cases, really at the end of the day, you're only going to be changing the size of your trade by not that much, so it's not really a big deal. Again, I like to trade at the 0.25 level. So, if you want a little bit tighter entry, you can use just the wick. This all comes down to how you want to refine it as well. I'm pretty loose in terms of using a little bit wider areas. I like to use slightly bigger stop losses because at the end of the day, I'm not looking to make 100R per trade. I'm more than happy with 10R because 10R a couple times a week scales very quickly, especially on large capital, which is the more appropriate way to approach trading versus, trying to make 30, 40, 50R per trade. Because that's great, especially if you have a large account, 100K, you make 30R and you're risking 1%, you're making 30K per trade. Sounds really great, but at the same time, I can risk 1% or even 0.5%, make 10R. I make 10% or 5% depending on my risk, whether it's 1% or 0.5%. That's still in a 100K account, $10,000 or $5,000 respectively. I don't know what Siri's doing on my iPad, but so it's just something to think about. I'd rather have a slightly wider stop loss to stay in trades versus trying to get things so tight and so precise that I get taken out of a trade, then I get that fear of missing out, or I'm trying to rush things. But anyway, that's kind of what I focus on. So I used a 2.5 pip stop loss, which for some people would look at this and go, this is absolute madness. Why are you using such a big stop loss? I'll give you two reasons. One, again, like I've said, I don't want to trade really tightly. I've been burned on way too many trades that have run to make crazy R or percentage that I was not involved in because I decided to be really tight because I wanted more R, which it's funny, that mentality. I wanted more R, but I ended up walking away with none because of that. Whereas if I'm okay with slightly less R, chances are I'll actually walk away with something to think about. And then second, I am weary of this area. The extreme is still something in the back of my mind. So I don't necessarily want my stop loss all the way up here. I mean, yeah, 3.7 pip stops, not a big deal, but something like that. This is where, a refinement could take place. And, in hindsight, maybe that was the play, because then moving something up here, 2.5 pips. If I did a 3 pip stop, I would have covered the high of this candle. Yes, it would have been tight for that zone, but it would have been a lot more broad for this zone. That's not how I played it. Reviewing the trade, that's definitely something that I've identified that, if you want a even more stronger level or trade that you can take, using just the wick and then turning at the 0.25 level with the stop just above that extreme high just makes your trade a little bit more padded, so you don't get taken out unnecessarily. And then the final reason why I tend to use bigger stops is on my personal account. I use TO Markets. They have a 3 pip stop loss minimum, so I have to use 3 pips. And I've been trading my personal account a lot more lately, so it's just a habit that I have to get into, and it's kind of translated to other accounts that I trade where I have the freedom to use smaller stop losses, but reflecting on other trades I've taken where I've been too tight and got taken out, it didn't make sense. So now I'm kind of sticking around anywhere from 1.5 to 3.5 pips is kind of where my stop loss likes to stay. It's comfortable for me. I don't need massive R. It just doesn't make sense for me. I have more than enough assets under management to make a good living from trading, so I don't need to swing for the fences on every trade. Anyway, so what we can see is we're looking at this level for many reasons. It's taken liquidity. We're starting to see that supply chain. Supply chain is just multiple levels of supply being created and respected. We had this level, we've tapped in, we swept liquidity, and we've broken structure. So if we're looking at it from a zone qualification refined video, I went through different probability factors for refinements on your zones. We have a supply zone that breaks structure. In this case, not the greatest. We're just breaking structure. And even then, the extreme does look better. But when we're looking at this second zone, and this is why I'm using the second zone, we sweep liquidity, we mitigate or create a supply chain, and we break structure. So we have basically everything. Plus it's a flip. So if we look at the qualification, we have literally everything that we want to see. If we're looking at it from an entry type model, this would be, I guess, suppose a confirmation entry because we didn't take the first one. That was the first change in mitigation, whereas the second one is now a more confirmed confirmation entry. So we'd be looking at that. So we'll just keep playing price forward. We'll see we create a short-term high right here. And from that, we could use that as a level of inducement that high is likely going to get run. Now we create equal highs, which is even better. What we can see is price is just kind of dancing around. We break structure one more time. Did this worry me? A little bit, but at the same time, my level is valid. I don't really see anything in here that showcases something that I would personally want to trade, so that was okay. Yes, you could look at this area, but I was looking at this and viewing this as more of a level of inducement, which is what kept me out of the trade. What we can see is we tap into the zone. So if I just move this over now, we're now in the trade. We've created equal highs. We've broken structures. We see price moving to the downside. Everything looks good. Do I move to break even yet? No, not yet. One, because I like to trade some sort of entry type structure break before I move to break even. So if I was looking at this, I would probably be more apt to trade once it breaks this. I also like to trade once we've taken out a level of demand, in this case, that gave the reaction or the pullback. So it would be something like this. We have our initial reaction right here. So if I just put on demand zone, so I'm looking at this from a demand perspective, not looking to buy or anything like that. It's just, this is the level of demand that's kind of holding price right now. We've moved up, we've come back down, we've reacted off of this, created a reaction, we took out that reaction. Now we're tapping into a supply that's part of the supply chain. So I'm realistically going to look to manage my trade to break even once we break this level. So we'll just keep moving forward. Everything's looking good. Then we start to see price move back to the upside. Now we can start sweating a little bit because, hey, maybe we're going to that extreme. It's okay. If we get taken out of the trade, we can still look to trade that. We can just trade another supply chain that takes place if that's the case. Price doesn't do that. We start moving to the downside, start consolidating. There are scaling opportunities here, but I wasn't interested in scaling in. I was busy with a few other things. I pretty much just left this trade on autopilot. Now that we've broken this level right here, we've broken this demand level, I can pretty much manage my trades to break even, maybe take some partials. I did not take partials. I just moved to break even and carried on with my day. So we'll just toss this on here as my stop loss, indicating I went to break even. What we can see though is that this demand zone, we had a reaction and then we moved to the downside. So what we can start to gauge from that as well, it's a much larger zone, but we have a supply zone here. If we want to be a little bit more aggressive, but also not aggressive because we're getting that confirmation, we could look to scale in. I did not, but it's something that you could consider. Something like a 2 pip stop loss would be more than good. We'll see if this plays. Price moves away, so it's showcasing somewhat decent. The level itself is probably not the cleanest. Let's see if we get tagged in. We do, and we'll just see what happens next. So when we're looking at this trade from this perspective, I took this trade. I didn't take this trade. It's just a valid scaling. It looks a little aggressive on the onset just because, this is a really weird looking level, but we need to just kind of ask ourselves, what did we react to? Supply is in control. Demand gave a reaction. That reaction got taken out. It doesn't take liquidity. So, maybe not the greatest area. We could probably look for some sort of confirmation trade in here, but, whatever. That's what we're looking at. So what we can do is go to the 15-minute chart and basically ask ourselves, what's the expectation of the trade that we're taking? Initially, what we'd be wanting to look at is pretty much price just revisiting this demand zone. That would be pretty much the key level that I would be looking to trade. If we're just looking at my trade, it's about 9.7R. This one's running, it would be at 7.7R. Again, if you're risking 1%, that's 9% and 7% respectively. If you're using 0.5%, obviously just half that. But basically, my general idea was that chances are these lows are probably going to go. Of course, the 4-hour chart did me dirty here, and it does show what happened. I mean, I'm sure all of you know what happened. A lot of people look at Euro US dollar anyway. It's more the thought process of how I got into the trade that I think you're more concerned about with and how I managed it. But I was mostly just targeting these levels because I knew that, one, we have a demand zone that we could get a reaction from. I'm happy with 9 to 10R. I think that's great. I'm not trying to be a hero or anything like that. I'm just trying to take the bag and move on to the next day, the next trade. So what we can see is we just keep moving price forwards. What's another level that I would be interested in kind of monitoring? It would be something like this. So we have a demand level. We're now tapping into the demand level. What we can see is, we get a reaction, and the reaction is just failing right off the rip. We start to break. So, where can I manage? Realistically, I can manage above these highs if I'd like. This one is broken at the demand, so maybe I'll move that trade to break even. So more realistically, manage both trades in tandem with one another. It's kind of up to you on how aggressive you want to be. This fits my plan in terms of if I had taken the second trade, we took out the demand that created the pullback that tapped into the supply zone. So I'm more than happy to move to break even because we took it out. Maybe you're not because you want to trade this level. That's totally fine. You can manage just above structure or take partials. It really comes down to what makes the most sense for your trading. What we can see is price begins to really melt. I was on the, this is only 11 in the morning. I was in a meeting for things and wasn't really watching the trade. So this was kind of surprising. So it extended my target just a little bit more than what I was initially looking at. I was happy when I seen that I was running at 10R. It's kind of one of those nice things you like to see. So once we got, it was about here, I think, it was about 11:30. I decided, for the time being, I'm going to manage above this supply zone right here, because to me, this is a pretty valid scale-in opportunity. If I'm looking to trade, I'm probably not going to look to trade because at this point, it's outside of my key trading window. I like to only trade till about 11 a.m. Eastern because that's when volume starts to die down. London's closed. New York lunch is about to happen. So it's kind of this weird period where there's just not a lot of action. And then the afternoon of New York can be exciting depending. I use the word exciting. I just mean that there's actual price action that takes place. But more often than not, after 11 a.m., I can go do other things. I can have lunch with my kids. I can work on other things in the afternoon, hang out, do what I want. And that's the freedom you look for in trading, right? So basically that's kind of the idea. It's already exceeded my expectations. And, once we hit about 11:30, I just started to manage it much tighter because at this point I'm happy with my 10R. If I go here, I believe this was exactly 10R. I scaled to, it's just over 10R, 10.1. I was fine with that. I said, if price continues to move lower, we can look at the 15-minute. Where realistically does price want to go? I mean, there really isn't a huge indication. This is where we start to use our time frames. We go to the 4-hour. We're in that 4-hour demand zone. So this is why I'm not necessarily looking to push this trade much further. I know we have a daily level, but I'm expecting some sort of pullback that's probably going to take me out. I'm okay with that because I've made 10R. That's more than enough for me. I don't really want to sit through a pullback, go through spread hours, Asia, London, everything else for the next day. Because if we look at today's price action, because obviously I'm recording this video the day after I took the trade, I just didn't have time yesterday. Price actually ended up moving to the upside, would have stopped me out anyway. So it's really the key kind of consideration there is just being aware of where key demand levels are, not to trade them necessarily. Like in this case, I'm just using it as an area to go, I know price is probably going to have trouble breaking this level. Initially, we're going to get some sort of pullback or reaction. So what is that reaction going to do for my trade? Am I happy to sit through that pullback because I think it's going to go further, to the downside in this case? Or would I rather be a little bit more aggressive with my management, bank the profits and be okay if price takes me out? That was my mindset on this because I knew I'm sitting through New York afternoon, then I have spread hours, Asia. Chances are price is not going to want to do much for this trade. So I was okay with that. I kind of stepped away and we'll just kind of play price forward just a little bit more and we'll see what happens. I think it kind of consolidates here. This is kind of, again, New York lunch. This is why price action is consolidating. So if we just think about it realistically, if you're in the Eastern Standard Time Zone, what is noon? Generally speaking, if you work a 9 to 5 or any sort of job, that's lunchtime. And, people are away from their desks, they're eating. So there's less people trading, putting orders in, things like that. And then we end up taking my trade out right there at this swing high. Yes, I probably could have managed maybe a little bit more tightly, after we seen something like this. Did we just hit that? No, we missed it. So it doesn't matter. I wasn't really actively watching at that point. So I was happy with the 10R that I locked in on this trade. But yeah, I just wanted to put that together. One, to, put a video that's not maybe strictly course related. It's kind of refreshing to be able to just kind of talk, share how I trade. Because obviously we're leading up to that and refined. We're just being a little bit slower than we hope. But yeah, I hope this was helpful in, the process in which I use to take trades, what a change of character is versus a break of structure, kind of the introductory from me on supply and demand zone flips, how to use them, how to kind of choose between the extreme and the decisional supply zone in this case, how we use liquidity to also help delineate where the price is likely to return to, decisional or extreme. And then just kind of the concept of supply chain, demand chain, using, demand reactions when supply is in control. So I'm always asking myself, who's in control, but more specifically, if supply is in control, why is demand giving a reaction? Generally speaking, it's giving a reaction to either create liquidity to be taken later to form a new point of interest, or it's creating liquidity to then tap into a previous supply zone, or it could be one and the same in this case where we created liquidity to create a new POI, because we swept liquidity, but we also tapped into a previous supply zone. We created supply chain, which gave more confidence that that level was likely to hold, and that was the basis of my trade. So yeah, I hope that was helpful. It was great to jump on a video. Definitely be expecting more from me as we go, but take care. Good luck. Happy trading.